You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. Today I want to talk to you about what to do when the market has a significant little dip like we're currently seeing in the crypto markets, okay? So basically, when you see your shares, your cryptocurrencies, or any assets you have go down in price, everyone's knee-jerk reaction is to absolutely freak out. Oh my God, I'm losing money. Now, what happens if during this time you sell? Yes, you could lock in some profits, but you could also lock in some losses. Now, this becomes inherently risky because obviously by making that transaction, not only are we locking in the brokerage costs in order to buy and sell those shares, but you're also locking in any potential capital gains that you will incur on this movement in the market. Now, for example, if you were to hold, say, 100 shares in a company, and you saw a 10% dip in price, but you had previously bought at $50, so you'd already doubled your money, you're going to lock in that capital gain just because you've made a sale, seeing those shares drop in price. So let's say that your tax rate was 35 cents, okay? Then you're going to lock in $17.50 tax on the profit in that $50, okay? So now if you were to then want to rebuy those shares, you're going to have less funds in order to deploy to purchase them, okay? So this becomes very risky because you're going to have less essential money to purchase these shares because you have to keep some aside for tax. And if you deploy all of the funds that you have post-sale, then you'll be left with the tax liability come the end of financial year, making it very hard to kind of, scrape together all those funds to pay it. If you're somebody who struggles with market volatility, then perhaps a volatile asset such as crypto or individual stocks in companies are going to not be the right investment for you, because what that's essentially going to do is create a lot of headaches for you because you're going to struggle to hold onto your assets and basically get your investment objective out of them. If you can't handle seeing your investment halve, then put it into investments that move less. So for example, with myself, I'm a little risk tolerant, so I can handle a little bit when it comes to cryptocurrencies, but I don't want to hold a large portion of my net worth within that because I feel like that volatility could be really bad if I was trying to retire later on. So I'm looking at just 1 to 2% of my portfolio is put into cryptocurrency. I can handle that if it drops, I'm not going to lose all my net worth. But I can also handle that I'm riding on some of the gains as that market increases over time. Now, this is very exciting, obviously, because you want to try and lock in some of those volatile assets that can have bigger upward trends. But this obviously comes with the risk of bigger downward trends. So most of my shares investing is actually in the form of low cost, well diversified index funds and ETFs. This means I'm paying very small fees to own them. I dollar cost average my money in every single month, meaning if the market has a nice dip, like 10%, 20%, whatever it is, I'm going to get more shares with the same funds that I was looking to deploy. If, however, I have a rise in the price in the market, it just means for that month, I get less shares for my same $1,000 that I contribute every single month. So no matter what, I'm making sure that I buy whatever is happening in the market because I wish to, over the long term, have that upward trend over time as the market continually rises. So I encourage you guys to figure out what your strategy is and what your risk tolerance is, and then create a portfolio split that works for you based on that. If you can handle YOLO bets where you put all your money into one particular asset class or one particular cryptocurrency or even a single company, if you can handle that risk, by all means, that's fine, but also be prepared for the other side of that potential gain, which is the loss in equal proportions. Now, I feel like it's very risky to obviously make these big bets in a single asset or a single company, because if your thesis is wrong, you're going to have a lot of funds that you will not have access to that could have been compounding with the market returns over time. So you need to figure out what your strategy is, and then you just need to stick to that relentlessly. For me, if I see the cryptocurrency market have a really nice rise, then I don't need to contribute any more funds for that week or that month, and I can deploy those funds back into shares and build up that side of my asset portfolio to rebalance. If I see a dip in crypto, then I can simply deploy some more funds into that, and this kind of rebalances things every transaction. Therefore, I'm not selling to rebalance, I'm buying more to rebalance. Therefore, I'm not going to keep locking in a capital gains tax event and potentially cripple my gains over time. Now, it's very important as well that you are prepared that sometimes you do need to get out of a fund or out of an asset class. So when you do sell, perhaps keep aside 30-40% of the proceeds that you earn back on the profit, if there is some. So if you doubled your money, okay, keep 40% of the extra money after you have returned your principal, or in an easier way to kind of word it, keep 20% aside. This will cover your capital gains tax liability, and then that will also allow you to have some cash on hand ready to cover that, whilst also deploying the rest of those funds into an alternative asset class. Guys, I think it's very important that when you are investing, you know exactly how you plan to split your portfolio before you even spend that first amount of money, so that every time you hear, you know, on Facebook, somebody saying, oh my God, crypto is going down, or buy Shiba Inu coin, you don't just follow where the news is, and you actually continually try to stick to your strategy, and you have high conviction for it. Therefore, you're not deviating away from the plan and crippling your gains based on emotional buys. You never want to YOLO into something. You only want to buy that which you understand. Sorry if you can hear any meows. A cat followed me into my apartment today. He's just jumping up on the couch now. So yeah, I guess he's joining us for this YouTube video. I was just about to film and he followed me in. So there we go. So when it comes to purchasing cryptocurrencies, when it comes to purchasing shares, make sure that you're diverting those funds into the asset class that is underweighted to your strategy, so you don't need to make as many sale purchases in order to rebalance. This obviously saves you that this obviously saves you that capital gains tax event on any gains that you would have made if you do not actually wish to sell to rebalance. Of course, take profits where necessary if you wish, or you find a better alternative opportunity. But don't sell for the sake of selling, because you'll get hit with a hefty tax bill come the end of financial year. So when we're looking at those sort of market dips, right now, cryptocurrency is going through one. Our boy Elon Musk just tweeted that Bitcoin is no longer going to be a suitable currency to purchase a Tesla car with. But he has also asked, will people be interested in using Dogecoin to purchase Teslas? Now he's working with Dogecoin developers in order to try and make Dogecoin a larger and more diverse and usable currency. Therefore, we can adopt this as a mainstream digital currency. The problem, however, with this is that for our mainstream adoption to occur, we need a lot of liquidity in the market, and that's why having just one or two people hold on to a large portion of the overall coins can be inherently risky. I'm just going to let this cat out of my apartment. So there you have it. We need to make sure that there is enough liquidity with these currencies, and the price is stable enough that it can be used as a decent form of transactable currency. The problem is, right, when there's huge fluctuations in price and it's volatile, if we need to purchase a good and then the amount of money we spend to pay for that good halves in value, then the supplier or the person producing that product may not be able to cover their cost bases by using this cryptocurrency. So they'll have to convert it back to cash, which means there's going to be constant sell-offs of this currency, causing huge fluctuations in the price. If every month, Amazon or Tesla were having to swap that Dogecoin amount back into cash in order to, sort out their balance sheet, pay suppliers, pay everyone that's putting stuff onto their platform, or, pay for their cars. If every time they receive Dogecoin they had to convert to cash, this is going to constantly put pressure downwards on the price. And therefore, you're going to have a very unpredictable crypto market when it comes to this. So anytime you buy an asset, try to very deeply understand it. Make sure you're prepared for the risk associated with that particular asset class. And then really, really try and stick to your strategy the whole time, because as soon as you begin to deviate and you listen to the noise out there and you follow whatever's trending, you're going to really, really cripple your gains, because every time you make that sale just to redeploy funds elsewhere, one, you trigger the capital gains event. You're also limiting the compound effect that you had by having your money in those assets. Now, I fully believe in perhaps selling down shares to pay off a debt or something like that, especially if the debt is higher interest than what you're earning by holding those shares. However, that compound growth, when left for a long time and not interrupted, is phenomenal. And if we can pay down those debts with our own cash, or we can, just deploy our new funds elsewhere and we leave our current assets alone, we can perhaps see phenomenal growth over the long term by letting them do their thing and keep ticking away. Especially when you have set up your dividend reinvestment plans, or you're holding growth stocks or growth index funds, which have index match returns with dividends reinvested reflecting in the individual share price. For myself, I hold the Vanguard United States Index Fund, which is called VTS here in Australia. And this has just had the most insane growth trend. In March last year, it got down to 190 Australian dollars and it's currently sitting at about $275. It just blows my mind how much growth that is. I'm very lucky to have bought some, but of course I wish I bought more. All right, guys, so that is my talk here about market volatility. And I really want you guys to try and stick to a high conviction strategy when it comes to negating your volatility or your risk tolerance, because anytime you go all in on a YOLO stock just because you're chasing media hype or you think it's the best thing, but you don't have a strong thesis, you are opening yourself up to a larger world of risk. Guys, thanks for watching today. Sorry about the cat interrupting, but I am a bit of a cat fan, so I was more than happy to let him follow me in just for a portion of that video. All right, if you get any value from this video, please like, share, and subscribe. Don't put all your money into Dogecoin, but there's nothing wrong with holding a little bit. Guys, I look forward to seeing you in the next video.